With the recent positive headlines, we're increasingly hearing from tech CEOs who say they're going to do a raise, then merge. Think very carefully about that, very, very carefully before you do that. From our friends at the World Financial Symposium, here's a recent exclusive report on exactly that topic.
With increasing market uncertainty, many startup and growth stage software company CEOs are forced to shore up their capital needs to fund their growth and ensure sufficient runway. M&A is often considered as an option when the company has reached a degree of maturity and is primed for an exit. Unfortunately, a lot can go wrong along that journey. Let's discuss why you should consider M&A early instead of a raise. Doing a raise. You'll give up equity without getting any liquidity. Raising a round will change your cap table. If you're raising an A or B round, you can expect to give up to 30% of equity or more. Any investment will involve dilution for shareholders, raising share prices, making eventual sales more difficult. While there may be a promise of a bigger pie, your slice will become smaller and smaller with every investment round. We often encounter CEOs who, after 3 to 4 funding rounds, retain less than 10% ownership, with little incentive left to exit. You may lose control. New investors may want to add board members to your current group, shifting the dynamics of the board and impacting voting percentages. This could have a significant impact if the board is not aligned on going to market for an M&A event. With the new investor in the mix, they may have different incentives than you as CEO. In the case of VCs, most will drive an early-stage company to spend their investment on growing, quickly creating the need for more working capital. Through uncertain economic times like now, they'll be the first to tell you not to worry, that they'll provide additional capital when needed. But forget to add that it'll come at a significantly lower valuation so that they can take control, what we call a down round. VCs also tend to have different decision criteria, holding on to the company for too long before putting it in the market, expecting that the investment will become one of the fund makers. You may end up with nothing. Most investment terms have preferred liquidation rights, favoring the last investors in and determining who gets paid first and how much they get paid when a company is ultimately sold. Investors or preferred shareholders are usually paid back first. This isn't a concern when the ultimate sell price far exceeds the preferred threshold, and there's plenty left to divide among the other shareholders. You may miss your optimal window. From the 2000 and 2008 recessions, we learned that tech companies can quickly lose 80% of their value when the market turns and take 4 to 6 years to regain their peak valuations. Many CEOs and founders missed their most opportune exit window then and never recovered. Is this a risk that you are willing to take? Funding sources dry up, and raising money becomes extremely difficult and time-consuming, especially for smaller companies. You're on a continuous treadmill working towards the next petty raise, tying up your and your CFO's time instead of focusing on the business. Unless you have a significant war chest to survive a couple of years of turmoil, you will become a prime target for vulture capital. You may get the board from hell. Your investors may not understand your business and its market dynamics. They may challenge you every step along the way, blocking you from making timely decisions, including when to sell your company and for how much. The M&A route. Immediate liquidity. There is an immediate opportunity for CEOs and founders to take some significant money off the table. No need to wait for risky promises that may never materialize. Higher valuations. Running a global process and targeting strategic buyers and PEs will almost always yield higher valuations because of the auction process. Your share price is not pegged on the offering you go out with. Harnessing your full potential. Acquiring strategics will also offer a significant value advantage for early-stage companies. Global sales and marketing footprint, operational resources, shared resources. Something that VCs and other capital providers cannot provide. A second bite opportunity. A common scenario with private equity firms is a 70 to 90% PE recap, where you get a first significant liquidity event and later on a second bite from the apple when the company is resold again by the PE firm. The payout of the second event is sometimes higher than the first one. Faster outcome. When you are raising and struggling to close a round, You could be calibrating your value with over 100 prospective buyers, get a full sell or a majority recap, a minority growth round, or even venture debt. You'll also gain valuable market feedback with the option to step out of the market should conditions be suboptimal. Valuable insights. The interactions with the C-level executives of prospective buyers may yield some invaluable insights. What do they like? What don't they like? What else do they see in the market? What would make you more desirable? What concerns them?
Thank you to the World Financial Symposium, WFS, for providing this presentation. With the improved outlook for the economy and values going up, we're seeing many companies go to market. In fact, we have 20 companies going to market shortly from all over the globe in every single market. Call or text us if you want a confidential analysis of your value.